in terms of regulation, but also in terms of encouragement, in particular to encourage Islamic financial instruments. To help us understand the area tonight, we have two very eminent individuals in this field of Islamic finance. First of all, we have a very eminent scholar, Sheikh Nizam Yaqubi, who's from Bahrain. Sheikh Nizam sits on a range of different Islamic banking Sharia boards, and he's going to help us to understand the relationship between religion and its influence on commercial developments. We also have Usman Ahmed, who is the CEO of the Citigroup Global Islamic Banking, and he's going to start off by giving us a presentation on Islamic finance and to help us understand its role in modern global finance. Now, Mr. Usman Ahmed is going to take about half an hour with his presentation. Then Sheikh Nizam will comment, and then we'll throw it open for discussion and questions. But first of all, Mr. Usman Ahmed. Thank you.
Good evening, ladies and gentlemen. Thank you, Professor Cranston. It's indeed a great pleasure for me to be here today. I would also like to take the opportunity to congratulate Professor Ross on his recent appointment to the Court of Higher Appeals for the United Kingdom as a judge, along with Professor Blair, who was with us today for the whole of the day at a seminar that was jointly organized by LSE and the Harvard Law School. I would also like to thank both institutions for giving me this opportunity. Today's session is broadly divided in two parts. We'll start with the presentation and do the Q&A as just explained. Both Sheikh Nizam and myself have attended the Euromoney Islamic Finance Seminar for the last 2 days, and we spent most of today on the seminar that was organized by the LSE. So we will hopefully be able to give you the latest perspective, and we look forward to an interactive session. Let me start by giving you an overview of the main principles of Islamic finance, as well as an overview of the market. Under Islamic principles, money is regarded as a measure of value and is not an asset in itself. What that means is essentially that profiting from the trade of money or lending is regarded as riba, which is not permissible. What is also not permissible is investment in certain prohibited industries like gambling, alcohol, tobacco, or entering into contracts that are purely of a speculative nature. Under the principles of Islamic finance, what is allowed is to profit from asset purchase, sale, or leasing transactions, from trading of goods, or investment in Sharia-compliant enterprises, for example, real estate or other assets. What this essentially means is that investors are required to take the risk related to ownership of assets to generate a profit for themselves. For example, if a company wants to finance its purchase of inventory, it has two options. It can either go to a conventional bank and take a loan, or it can come to an Islamic bank, and if the Islamic bank finds the due diligence it's done to be acceptable, it will buy the inventory from the supplier, take momentary ownership of title of the goods, and hence qualify for the profits related to the sale of that inventory to the customer on a deferred payment basis. The deferred payment leg will essentially create the credit for the customer, and for the investor, the momentary ownership of title will give it the right to earn a profit on the transaction. What this essentially shows is that ownership of title is critical to demonstrate under Islamic finance that investors are investing in the real economy. It also shows that there is nothing stopping an investor in the Islamic market from participating in the same economic activity as conventional banks. And just because the Islamic bank is meeting the same customer need as a conventional bank doesn't mean that that activity is akin to conventional finance, or that indeed the Islamic bank is not entitled to take security or third-party guarantees or use other forms of credit enhancement to secure its effective exposure towards the customer. Now, with that background, we'll go into the market. The scale and scope of application of Islamic finance has grown dramatically over the last few years. There are some 525 estimated financial institutions today with assets under management of over $500 billion. The bulk of this money is domiciled in the Middle East and North Africa, and within that concentrated in the GCC. As you will see that the GCC has been growing at the rate of approximately 40% per annum, whereas overall on a global basis, the Islamic industry has grown at about 15% per annum for the last several years. This growth has primarily been fueled by petrodollar liquidity. As we all know, oil prices have been at a record high for the last several years. There's been increased product innovation in the industry by the entering of new international banks who wish to be active in the region. They have driven the growth and innovation aspect of that. There's also a growing population of Muslims who are categorized as practical, interest-averse Muslims, people who will essentially prefer to take an Islamic product as long as it does not in any way compromise the functionality of the product or the economic benefits for themselves. The other interesting phenomena that we have witnessed and also benefited as institutions is how the demand for Islamic equity has been driving the growth of Islamic debt products. What I mean to say is that when an institution issues stock in the market, for the stock to be Sharia compliant, no more than 1/3 of that company's debt is allowed to be on a non-Islamic basis. So for investors who wish to invest in Sharia compliant equities, the only way that they can do that is if the company that they're investing in does not primarily borrow on a non-conventional basis. And hence companies in turn that want to attract those investors have to borrow on a Sharia compliant basis. Now, why is all this relevant? It's relevant in the current environment because, as we know, the Middle East is the most capital surplus region in the world. For investors that are wishing to diversify their sources of liquidity, they can tap the Middle Eastern market on the most inclusive way possible by structuring their financing on a Sharia-compliant basis. Islamic banking today represents between 25 to 30% of the banking system in that part of the world. Accessing this liquidity has become easier than before as Islamic structures have become increasingly standardized, and the cost and time to market is now comparable to conventional financial facilities. Sukuk issues, which represent the Islamic equivalent of fixed income instruments, are now priced in line with their conventional counterparts, and the costs associated with structuring these instruments has gone down significantly. Moreover, in recent months, we've seen that more and more issuers from the Western world are looking to tap the Islamic market. That is because there's been a global credit squeeze, there's a financial crisis in the West, and the banks in the GCC have been largely unaffected. That's why we're seeing a greater interest in Islamic finance, even from corporations that are not really driven by Sharia motivations. Within the Islamic banking universe, the Islamic capital markets has been growing at the fastest rate. For the last 3 years, the compounded annual growth rate has been over 100% per annum. The first Sukuk issue was done in 2002 by the government of Malaysia. That was a $600 million transaction. 6 years down the road, the annual issuance has boomed to $50 billion per annum. What we've also seen is that in addition to fixed income bond type instruments, there's been an increased move towards equity-linked issuance, in which investors have the option to either redeem the sukuk for cash or exchange their sukuk for shares of the company should the price for the exchange offer them a profit at the time based on the trading price of the shares on maturity. Islamic banking has not just been limited to financing transactions or investment products. It is also extended into risk management products through the use of derivatives. For example, investors that would like to hedge the currency risks associated with their investments